Good evening and a very warm welcome to all our viewers to the 40th edition of Cedrus Knowledge Series. The objective of initiating this Cedrus Knowledge Series was to feature a speaker each month, speaking on a variety of topics encompassing not just finance but personal well being. We'll now play a short video of Cedrus Wealth Partners. 40th edition, we are extremely pleased to have with us Mr. Charanjit Singh. He's the fund manager at DSP Mutual Fund. And Mr. Singh has a rich experience of more than 2 decades in the capital goods, infrastructure, and the real estate segment. We'll now play a short video to further introduce him. A very warm welcome, sir. And we all have seen that India is shedding old paradigms, embracing new possibilities, and which is embodying a bold vision for the future for India. And this resonates with the spirit of progress, innovation, through the ways where the government is spending and focusing on infrastructure. And we have seen a stupendous rally in the infrastructure segment. We all are eager to hear your views on this transformative journey for the new India. Once again, a very warm welcome, sir.
Thanks, Sonati.
And
Yeah, thanks thanks for inviting me to this platform. Thanks to Sidrus Wealth and Nilesh for organizing this. Uh, I think it's a privilege to interact with all the investors and help them and understand this entire infrastructure journey for India, where we are and where we are going to go forward for the next 3 to 5 years.
it's an honor as well to have the opportunity to interact with you and hear your views, sir. And
Thank
I will now hand it over to Mr. Nilesh Bajaj for taking the discussion forward.
Thank you, Unnati, and welcome Charanjit to the 40th edition of Steadless Knowledge Series.
Thanks, Nilesh.
Welcome all our viewers who have been watching this since the last 40 years, 40 episodes. Uh, in fact, as we close this financial year, we have seen one of the best rallies in the capital markets. The mid cap and the small cap segment have rallied. You have seen index touch all-time highs, and I'm sure investors who have participated in the equity rally, they have benefited by holding on to the equities. But the even bigger thing is the rally which we have seen in the infrastructure segments, the stocks which typically represent infrastructure are either from the power sector, from the construction industry, or from rail, and many more. I'm sure not all have participated in this segment because it's been a much more broader based rally. We at Sectors believe that in the future, next 5 years, with outlook of a stable government, increased focus of the government of on infrastructure spending, which they want to realize their dream of turning India into Bharat. And the most important thing is basically how this is going to spur the economic growth once the infrastructure is in place. This brings to a few questions because there is on one side where we have seen a big rally which already has happened. Second, you see half of India which is almost dug up. So I think, any city you go
Hmm.
by, you go by the highways. Anyway, you are just seeing frantic activity on the infrastructure front, and that's the second thing where we are looking at opportunities also. And this brings to a basic question: is there this rally which has happened in the last 1 or 2 years here to be? Because we see a lot of focus of the government on infrastructure, uh, or you need to be a little cautious. So Charanjit, my first question to you actually is related to this, uh, that can you elaborate, and what are the opportunities you see in the future with the government being the key spender in the over it's been a past decade where the government is only spent, and
Hmm.
last 5 years we have seen a huge
Yeah,
focus on infrastructure. So could
correct.
you elaborate more on this?
Yeah, so Nilesh, thanks for setting the context, for this discussion. So one thing, which I am telling investors is, when you look at infrastructure, so like you rightly said, everybody thinks about that. There's a lot of road construction happening. There are a lot of things which have been dug up. But this cycle in infrastructure is really very different. You have to broaden your horizon in terms of looking at infrastructure not as just construction play, but even very large sector which is coming into picture is manufacturing. So manufacturing brings in a lot of multiple sectors along with it, and then these cycles tend to go for longer than maybe just 2 years what you have seen right now. So it is that when you are looking at the cycle, this is just the beginning of the cycle. That is what we are seeing right now based on the data. So if I have to go back in time and look at 2004 to 2007 time frame, that was when we saw a super capex cycle for India. Globally, commodities were doing very well, and we as a country were also spending heavily, and both government as well as private sector were doing significant capex. So which were the sectors which were booming at that time? If we go back in the past and see, it was power. We were adding thermal capacities to the tune of almost around 20 gigawatt per annum. Oil and gas capex, telecom, metal, and cement. These five large sectors we were doing the capex at that point of time. Post global financial crisis, what we saw that companies had leveraged balance sheets, overall demand collapsed, and we went into a very long downturn where private sector didn't invest from 2012 onwards till date. But now what we are seeing is, one, like you rightly said, that central government has taken the initiative to first drive the capex.
Hmm.
Second, the private sector will follow. So, like I
Hmm.
just now talked about, in this cycle, again, we are seeing power sector coming back in the form of renewable energy. Today, we'll be doing 10 to 15 gigawatt of renewable energy addition. In 2 years time frame, we'll be talking about almost around 30 to 40 gigawatt per annum of renewable energy addition.
Hmm.
Oil and gas, we are seeing, refiners adding capacities in the petrochemical space.
Hmm.
Steel and cement, like you rightly said, there's a big spending which is happening on infrastructure. As their capacity utilizations go up, they don't have an option, but they need to expand capacities. And to give you a data point, the top players in the cement space have 75% capacity utilization right now. The
Hmm.
top players in the steel sector have 88% capacity utilization right now. It means that if this infrastructure spending continues, these companies need to add capacities.
Hmm.
Telecom will see 5G capex coming in. Now, these are the sectors which were there in the previous cycle.
Right.
Now, you rightly said these sectors are definitely coming back. But is there something else also happening in the economy? Definitely. The things are changing in a big way. Now, if you look at railways as a sector, didn't exist in the previous cycle.
Mm-hmm.
In 2014, on railways, we were spending 45,000 crores in a year.
Mm-hmm.
Today, on railways, we are spending 2 lakh 50,000 crores in 1 year.
Mm-hmm.
This is the kind of jump which we have seen in terms of spending on railways. So, what it does is, on top of these five sectors, another new sectors got added, which is railways.
Mm-hmm.
Fine.
Right.
Second is defense sector. We
Mm-hmm.
never used to talk about defense manufacturing in India because everything was imported for us. But now
Mm-hmm.
what is changing? That government has put bans in terms of defense imports. And
Mm-hmm.
all this defense equipment has to now get indigenized and significantly, boosting our defense manufacturing, and in next 3 to 5 years boosting our exports in the defense space. So what you have
Mm-hmm.
seen is another major driver getting added to the overall context of manufacturing and this capex cycle.
Right.
Another important aspect is manufacturing as a sector. See,
Mm-hmm.
India as a country has been importing either crude or defense equipment or electronics,
Mm-hmm.
which is becoming a big issue from current account deficit, from currency perspective. That is where government has taken this task to actually ban a lot of these imports and start building a manufacturing ecosystem in India.
Mm-hmm.
So in that way, manufacturing, like I said, this economy is going to shift from consumption and services driven economy to infrastructure and manufacturing driven economy. You
Mm-hmm.
cannot have consumption without having good paying jobs.
Mm-hmm.
That is a circle. You need to create jobs by putting in manufacturing capacities, by creating infrastructure, and that will only drive your consumption. That is where the shift is coming in, and that is where you need the, understand the underlying themes of each of these sectors.
Mm-hmm.
Then, water as a segment, there was no focus on this segment till 2019. In
Mm-hmm.
2019, the government came up with a new ministry called Jal Shakti Ministry. That is where all the efforts on the water sector started getting a focus. But still, till 2021, we were spending only 10,000 crores of money on water as a segment. Last year, we have spent 70,000 crores only on water. This year,
Mm-hmm.
again, we'll spend 70,000 crores on water. So, what you
Mm-hmm.
have seen is another large sector getting added into this overall capex theme. So when
Mm-hmm.
you see this cycle, you are seeing five existing capex drivers and more new capex drivers getting added, which is giving us the confidence that the things
Mm-hmm.
are picking up and some of these sectors will see continuous traction going on for the next 5 to 8 years time frame.
Mm-hmm. So, Charanjit, what I can understand is that compared to the previous cycle, you have a lot of new additions, in fact, where
Correct.
the focus is. So, you have talked about railways, you've talked about water management, you've talked about defense, in fact.
Yeah.
And it's more of manufacturing focus. Actually, the focus is more
That's
on
true.
manufacturing. But in this budget we talk, the minister even talked about basically ports, for example, in fact. And there is urban, the urban space also, where we're looking at that we need to spend on infrastructure in urban locations. Just for example, what you mentioned about water management,
Hmm.
or maybe sewage systems and everything. So, but the issue is that it's great that we do have so many different sectors participating in this great infra, uh, you know, spending which is happening in India. But previous in the previous cycle, what we noticed, Charanjit, was that I think we saw huge rally in the infrastructure space in 2007. I remember. Okay,
Hmm.
when I remember there were multiple infrastructure funds which were launched. DSP Tiger was an old one, in fact. It's been there almost since 2 decades now. Uh,
Yeah.
but uh, but we saw a lot of excitement around that space. And then you saw all these 2G scam and coal scam, and then you had, all these issues where bankers went had an issue with defaults, in fact.
Hmm.
What is different? How is the government right now handling it in a different way, that we don't repeat what happened in post 2007 8, when this whole thing was happening? And you saw even in the power sector, I remember a lot of
Yeah.
banks actually had the biggest NPAs from the power sector, in
Hmm.
fact. And in 11, 12, 13, we actually went into that fragile five just because of all these issues.
Hmm.
Okay. uh, what is it, how is it different this time, in fact?
Yeah. So I think that's a very important question, because investors generally have that question: how is it different? Now, if you look at the previous cycle, there was a time when companies were building these infrastructure assets by taking extensive leverage.
Hmm.
See, India as a country has gone through that learning curve of last 10, 15 years, how to build these infrastructure projects, how to have right projects which can have right kind of return ratios for the investors to come in, right?
Hmm.
So, for an example, now if you look at power sector itself, there was a huge buildup of power capex, and that was entirely being driven by the private sector companies. But after that, what we have seen is we didn't see the rise of the manufacturing sector in India. Manufacturing or the private sector capex remained dormant for quite a long time. So the capacities which were built at that time from 2004 to 2016, they couldn't get absorbed till date. Now only what we are seeing the absorption coming in. But as we are seeing now the GDP growth rate picking up, a lot of these capacities are now getting exhausted. It means that we need to start doing capex and start building those assets right now, otherwise we'll be left behind. Now,
Hmm.
one is the part that there is a genuine requirement or demand for these assets,
Hmm.
because if you look at power itself, over the last 10 years our power demand growth has been 5.5% on an average. But what
Hmm.
we are seeing is in last couple of years, last 2 to 3 years, this is accelerating further, going to
Hmm.
6.5, 7% and much higher demand growth. And what we see is that it will accelerate further. Why it will
Hmm.
accelerate further is because the new kind of loads coming in. So it means that the power capex is not an option; it has to be done, right?
Hmm.
So the first is that this will not be a capex cycle which will be driven just for the sake of expanding capacities, but this is what is our requirement. Second is from the government perspective itself, government has also made sure that once the projects are announced, they have the real, kind of approvals, land acquisition is in place,
Hmm.
and then only the financing happens. So I think that was another thing which was brought in, and after 2012, we saw a lot of projects which will get stuck because of the land acquisition issues,
Hmm.
environmental clearance issues, and these issues had to be resolved. By
Hmm.
2014, these issues started getting resolved, and what you could see is then sudden bump up in the in the overall infrastructure spending by the government once these issues got resolved, and that's where bankers also started lending to these infrastructure projects. One of the
Hmm.
sector where we saw big changes coming in specifically was the road sector, because in the
Correct.
road sector this issue was very significant because a lot of projects were ordered out on a private basis, which was called BOT, build operate transfer.
Hmm.
So here a lot of contractors or the developers got stuck because they didn't have the land acquisition, they couldn't complete the projects on time, and they were not able to then fulfill their commitments to the banks. Then
Hmm.
government brought in something called a hybrid annuity model in the road space, which was that here government will put in or NHI will put in 40% as grant, and the remaining 60% will be brought in by the developer. So it reduces the risk for the developer and
Hmm.
make sure that 80 to 90% of the land is acquired before the project is ordered out. So I think these were the learning curves which we have gone through in terms of the building our infrastructure, how the projects are announced, which milestones have to be achieved even before the project is ordered out. And mind you, now it is not only the banks which are keen to fund our projects. See, there's no
Hmm.
dearth of capital for now in India, because that's an important question, that what will happen to the financing. So there are
Hmm.
a lot of multilateral agencies like Japanese Intercorporate Bank, World Bank. All these multilateral agencies are very keen to fund the projects in India, because now they are seeing the viability is better over a
Hmm.
longer time, they can earn better returns. And if you look at globally, a lot of these pension funds, they are not finding that kind of assets which can give them this kind of returns over longer term. I think that
Hmm.
is also attracting this capital to India, And we are saying the nature of the cycle changing, where
Mhm.
government is putting in the money, where government is making sure that the projects are viable, where government is making sure that the financing is also available through multiple other routes, and not only the banking system, which has been generally the main funding mechanism in the previous capex cycle. So I think this is what is a major difference versus what we saw in the previous cycle. And what we also see is now in this cycle, private companies have their balance sheets which have deleveraged.
Mhm.
NPAs for the banks have come down significantly. So
Mhm.
private sector is still waiting to do the capex, and what we see is once the policy continuity is there, the private sector capex will come back. I think
Mhm.
they are now at a position where they have very strong balance sheets with cash on books. They are deleveraged significantly, and the demand outlook is improving. So
Mhm.
previous cycle, what we had seen is also after global financial crisis, the demand outlook deteriorated. I
Mhm.
think now the scenario is different. The demand outlook is overall improving because of a lot of this build up in the infrastructure space.
Mhm. So broadly, what I can understand, Charanjit, is basically broadly three things which have happened. One is the hybrid annuity model, where the government is putting in 40%. So
Yeah,
that is something where they do have money which they are putting in. So bankers are not put at risk, or the infrastructure players are not put at risk. Second thing is what I can understand is that the previous cycle it was more of private sector driven, but now the government is focusing on their existing, the government itself is spending actually, and their through
yeah,
their agencies. And third thing is basically that in the previous this thing, you did have a lot of focus on on the banks were actually lending, and they had a lot of NPAs. Whereas in this cycle, we are coming out with a very very clean bank balance sheet,
yeah,
deleveraged companies, so that will help, in fact,
right,
to sustain this infra cycle. In fact, what you can say, in fact,
true.
wonderful. But one thing I wanted to ask you is this is more to do because you've not mentioned. You did mention about defense sector. You did mention about rail sector. We have seen a huge rally in this sector. On one hand, okay, you've seen a very big rally in these two sectors. Most of these stocks have already risen to multifolds in a very short period of time. So my first question related to this is that when you have seen such a big rally and the valuations seem to be expensive, what is your advice on that space? And second is you have not talked too much about ports actually, and the airports actually, the
Hmm.
airlines also, in fact, that is also a part of infra. What is your advice, and what is your take on these two spaces actually?
Yeah. So now the point is that if you look at the ports and the airports infrastructure side, what we are seeing is that logistics as an area of focus is there for the government in a very significant way. The reason for that is right now, if you look at our overall logistics cost, it is at around 14%, and they want to cut it to half to almost around 7%. Because if we want to become a manufacturing economy, it means that our logistics has to be very competitive. That is where the focus is coming in, where government wants to build more ports, government wants to build more airports, and even privatize more airports. And what we'll
Mhm.
see is that now this aspect of building port and airport infrastructure will see further acceleration as we go forward. Additionally,
Mhm.
what we are also seeing is now airports have got a very good regulatory mechanism, where airports are not just airports as an asset, but also airports where you have a non-aero revenue, which gives you a growth of almost around 15 to 20% as this consumption pattern goes up for India. So I think
Mhm.
for each asset there is a different mechanisms which are getting evolved in terms of how best revenue generation which we can happen, how best we can also have a port connectivity. See, why is this railway infrastructure being built? Because they want to do have a great port connectivity, a great
Mhm.
energy corridor which can
Mhm.
uh, move a lot of these materials across the country and to the ports, or if even if we are importing, can move to the manufacturing locations or to the power plants. So I think
Mhm.
all these activities are part of the entire logistics push, and this will again continue to see focus going forward in terms of one privatization, uh, secondly in terms of the revenue models, thirdly in
mm,
terms of the public private partnership. This will continue to happen on a big way. Now coming to your
mm,
question in terms of valuations,
mm,
so definitely we understand that valuations in a lot of these segments have run up significantly. Some of these
mm,
stocks used to be significantly undervalued, so there's a lot of valuation catch up which has happened. So what will
mm,
happen is now maybe these stocks will not see that kind of a re-rating. There'll be more of
mm,
a compounding effect because the spending by the government will continue, but you will not see your PE multiples re-rated. So it will be entirely driven by the compounding effect of maybe 15 to 20% kind of a earnings growth, which will come on as the spending continues. Plus, when you are
mm,
saying railways, see, railways is a big ecosystem. Railways consists of, what's the kind of capex which railways does? Railways does capex on new lines, gauge conversions, rolling stock, electrical signaling. All this is multiple capex which is being done by railways. So in
mm,
terms of when we are participating in the railways capex, are we looking
mm,
at just very few companies which are focused on the PMC part of railways, or which have just the railways in their name? No. We are
mm,
looking at a bigger basket of companies which are in railways, companies which are
mm,
laying these lines, which are the contractors for
mm,
railways, companies which are providing them the electrification part, be it the transformers or setting up the OHE lines, overhead electrical lines, or companies which are going to supply them the locomotives or the wagon manufacturers,
mm,
companies which are going to provide them the signaling, which is going to become the next big initiative for the government. So I think you have to look at a holistic picture of
mm,
all these companies, and then look at where I'm getting a best risk reward return, where I'm also getting the value in terms of having a re-rating from here on, and then participate in that opportunity. So that's where I'm saying that when you look at this theme, this is a very broad theme, and
true.
you need to look at each of this piece individually and then pick your right pockets where you have both value as well as growth, and that is
Mm,
how you'll be able to make the best return. So even in the defense space, a lot of these companies, they used to be available at around 10 to 11 times PE multiple.
mm.
Today they are trading at 30 times PE multiple.
These are
So the
typically the PSU stocks, I guess.
very true. Yes.
Yeah,
So these are the
yeah.
defense PSUs. So
Mm,
when we identified defense sector 2 years back, the whole thought process was that one, they are severely undervalued. Secondly,
mm,
if the defense space is changing and going to grow, the defense PSUs will be the first beneficiaries of this change because they have
mm,
invested and they have built the products. Now, what is
mm,
happening for the defense PSUs? That
mm,
sorry, the opportunity is expanding. The
mm,
products, maybe a company which is making fighter planes or helicopters, they have spent 15 years to develop these products. Now they're getting the acceptance and orders for delivery for some of these products. So it means
mm,
that this cycle is now starting and going to continue for the next 5 to 10 years for some of these companies,
mm,
right? Similarly, companies which are into the missile space, they are seeing a
mm,
lot of traction in terms of new orders which are coming in. And what we are also seeing is that some of these companies are sitting at a tipping point where the
mm,
exports will start picking up significantly for them. So maybe
mm.
in the near term, there could be some time correction because
Okay.
they have re-rated significantly. But do their
Mm,
earnings have the capability to grow? Yes, they have, because now the sector is opened up for them. The policy measures are in their favor, and
mm.
there's an additional opportunity which is opened up for them, which is an exports opportunity, which was
True.
not there even 1.5 or 2 years back. So this is
Mm,
how we look at different subsegments within this very broad theme of the infrastructure manufacturing space.
mm. Wonderful. Actually, these are some things which someone who's managing a fund only can actually give throw some light on, because as advisors we look at the overall rally which we have seen, and it's been a wonderful rally. But it was very interesting. About 5 6 years back, I remember we used to meet a lot of the old investors, who were senior citizens, and they used to invest in these PSU stocks just because they got a huge dividend yield. Okay. And we used to tell them आप dividend deal के लिए invest नहीं करना चाहिए, you should invest for growth. And
Hmm.
I think they have proven all of us wrong. Okay, I
Yeah.
think they have got a good dividend deal, as well as you have seen a huge rally. in this
Hmm.
the whole PSU basket of, be it railways, power sector, defense. There are so many of them where you've seen multifold rally which has come. I'm sure that yields have come down, but they're happy with the capital gains which they have got, in
True.
fact. So, now coming to the risks, what kind of risk do you foresee in this space, which can derail the capex cycle or the infrastructure spending? What is the are you foreseeing any kind of risks?
Yeah, Nilesh, I think risks are part of the investment journey, and
Hmm.
as an investor, you have to be always aware about the risks and then
Hmm.
take your calculated moves in terms of picking your stock ideas and themes.
Hmm.
And if I look back 3 years, 5 years back, I think the risks were always very similar. What is the how the government changes will impact. We are sitting at the time frame where we are going through that transition, global slowdown, private sector capex has not picked up. We have seen multiple false starts. Technology is an issue, raw
Hmm.
material issues. So these risks, as I say, have existed 2 years, 5 years back, and
Hmm.
they even exist today.
Hmm.
Fine. But as an investor, you need to take a calculated move or a call in terms of which companies have what kind of a risk and is there a mitigation to that risk. Fine.
Hmm. Hmm.
So the point is that one, some of these risks or volatility which comes in the market could also be a good opportunity for us.
Hmm.
We have seen, some correction in the small and the mid cap space, and we are also going
Hmm.
through a volatile time when
Hmm.
we are getting into an election phase.
Hmm.
What happens in an election phase is that the entire activity of the government slows down,
Hmm.
just comes to a standstill. Now the
Hmm.
point is that whether you get worried that what will happen in the future and wait out, or you
Hmm.
say okay that I'm getting some corrections and maybe I need to start deploying some more money. Right.
Hmm.
Now as an investor, if I go forward and start looking at post 6 months down the time, in the future, maybe the thought process could be that if there is a policy or public, political continuity, then what will happen.
Hmm.
So if that is the kind of scenario like you also highlighted, if there's a continuity, it means that all these policy measures, what we have seen till now, infrastructure
Hmm.
push, digitalization, push on
Hmm.
manufacturing, multiple reforms, they will continue for another 5 year period.
Hmm.
Some of the reforms, like I talked about the defense sector,
Hmm.
like I talked about the push on the water sector, which have just continued, started in the last 5 years, they will
Hmm.
start showing their big benefit in the next 5 years.
Hmm.
Fine. So then, as an investor, you are looking at an opportunity that okay, maybe next 3 to 5 years are going to give me much larger opportunity to reap benefits of this public policy continuity.
Hmm.
Fine.
Hmm.
Now coming to the second risk of private capex. As we talked about, now private companies are running at 75% capacity utilization. They have strong balance sheets. They don't have an
Hmm.
option to not go and spend. If they
Hmm.
see the continuity and the GDP growth rate growing, they will come
Hmm.
into the market and start investing. And what we are seeing is specifically for the production linked incentive schemes, there's already a committed capex, and that too 75 to 80% capex being committed by the global MNCs who are
Hmm.
coming to India. Right
Hmm.
now, coming on to the global slowdown, everybody is worried about the exports continuing to remain weak.
Hmm.
Maybe we could see the Red Sea issues continue for the next 3 to 6 months more. Once
Hmm.
some of these issues get resolved, then again we can see the things kind of normalizing in some of the global markets.
Hmm.
What we could also see is that exports again starting to pick up.
Hmm.
So I think that is again what will happen in maybe 6 to 9 months. We don't have the answer right now, but maybe the data points are showing that some of these things might start improving going
Hmm.
forward. But nobody knows that whether it will happen or not. But this is our thought process that okay, based on the data what we are seeing right now, there could be some improvement.
Hmm.
Now coming on to the reforms process. What we are
Hmm.
also seeing is that if you look at the government, last 5 years they have pushed various reforms.
Mm-hmm.
And now going forward, again we see reforms for power distribution, mining sector,
Mm-hmm.
focus on housing, focus on water. These themes will continue in a big way.
Mm-hmm.
So as an investor, then you need to pick the companies which have the potential to ride all these big themes,
Mm-hmm.
and also have very stable balance sheets, strong cash flows. Even if there is a timing issue, they should be able to ride through that storm. But
Mm-hmm.
once the things normalize post election, then, like you're rightly saying, there could be a focus by the government for the next 100 days, how they want to execute the things on the ground. Then there
Mm-hmm.
could be also a long-term agenda or the strategy which government wants to bring in for the Viksit Bharat, which will again lay down the strategy for our growth projection going forward, which will be driven by infrastructure and manufacturing. There has to be shift from consumption and services. Right now, manufacturing as a percentage of GDP is only 18%.
Mm-hmm.
54% is services. And what
Mm-hmm.
we are seeing is increasingly a threat to the service based economy. So,
Mm-hmm.
what we need to also have is very sticky manufacturing setups which are catering to the domestic market, which will drive this growth and overcome some of these risks. But definitely, these risks are aware, we are aware about. We try to, see how they are impacting our companies in the portfolio. Maybe sometime takes cash calls and then
Mm-hmm.
wait for the right price point where we can add the stocks which we see have a very long term potential, at least for next 3 to 5 years.
Mm-hmm. Wonderful. In fact, my last question to you is, the fund which you are managing. It's a which is the DSP Tiger Fund. It's been a almost a 2 decade old fund.
Yeah.
It's a true to the label fund. That's a very important thing, because I see a lot of infrastructure funds which have unrelated sectors which are a part of this whole theme. And so, the most important thing is, currently, I'm sure you must be getting a decent allocation, in this space, because definitely there are a lot of investors who are investing in the infrastructure sector. So what is your strategy, your broader strategy, as well as specific to sector specific strategy for this fund?
Yeah. So if you look at the Tiger Fund, the full form of Tiger is the Infrastructure Growth and Economic Reforms Fund.
Hmm.
Fine. So what this fund does is it will invest in all the core sectors. Where it will not invest in is lenders, IT,
Hmm.
pharma, and consumer staples.
Hmm.
Because if you look at these four sectors which are in the exclusion list, and like you rightly said that we are true to the label, these
Hmm.
sectors you will get in most of the other diversified funds in very large weights.
Hmm.
Right now, the weights of the core sectors in the Nifty 50 index, where Tiger Fund
Hmm.
invests, is at
Hmm.
around 30% weight.
Hmm.
This weight in December '07 used to be
Hmm.
70%. That is
Hmm.
the kind of weight reduction which has happened. So it means that if you need to have an exposure to a thematic fund, another important point,
Hmm.
Nilesh, that thematic fund is different from a sectoral fund. What
True.
is the difference? Because
Hmm.
thematic, like you rightly said, there are multiple themes which you can participate in. You can
Hmm.
participate in power, railways, water, defense, mining,
Hmm.
oil and gas space, telecom,
Hmm.
building material, cement. These are all
Hmm.
the core sectors of the economy which starts picking up as the economic activity picks up.
Hmm.
These are the sectors where Tiger Fund invests in.
Hmm.
So I think that is the whole strategy. Because the weight and the indices is very low for these sectors, you need to have a thematic exposure. You can have a 10 to 15% allocation in your portfolio as a satellite portfolio for these thematic funds. But the
Hmm.
risk versus a sectoral fund in a thematic fund is lesser
True.
because of the fact that you have multiple sectors to participate in. And like you're rightly saying, if we see that the valuations in particular
Hmm.
subsector is too pricey, we will
Hmm.
exit or we'll switch out of those particular sectors and move into the sectors or subsectors where we are seeing there's a value emerging. So
Hmm.
that is a good flexibility which we have in the thematic fund. If you look at the Tiger Fund also, we have 30% large cap and 70% in the small and the mid caps.
Hmm.
So it means that a lot of these opportunities which we have talked about right now, be it in the power sector, like cables and wires, transformer companies, they are not available in the large cap. They're available
mm,
in the mid and the small cap.
mm,
Be it the mining space where we are talking about mining equipment, the explosives market or the refractories market, you don't see in the large
mm,
cap but in the mid and the small cap. And these
mm,
companies have the potential to give you exposure to these subsectors which are going to see the growth. So, as our
mm,
framework or the process, one is that we need to have a clear understanding of each of the sector which we want to
mm,
own. How large is that market? Whether there is a valuation mismatch, like we said in the defense sector, it existed.
mm,
Whether there are other players which are, or the other stocks in this particular sector which are still not re-rated and have the potential to re-rate as the overall market expands.
mm,
So I think the first point we have to very clear, how large is that market? Is
mm,
power market going to grow even beyond this 2 years, what we have seen in terms of the rally? Definitely it
mm,
is going to grow. Can it grow for just 2 years? It can grow for actually 5 years because of power demand growth is accelerating. Fine. Then you come on to the stocks. Within the power sector, you want to participate through utilities, which are large, utilities who own power plants or who own transmission lines, or you want to participate it through the cables and wires companies, through transformer companies, or through the contractors who actually execute these projects. So I think
mm,
within these each sector, subsector, we try to find where the right value is available. Then based on that and the visibility on each of the sector, we assign the weights and build our
mm,
positions. So
mm,
that is how our entire framework is. And if we see that a stock is kind of fully valued, already factoring in the growth which we could expect going forward in the future, we will try to switch it out and move into the stock where we have the option available of making a better return. So I think that is how this entire theme, which is a very broad theme, gives us the
mm.
opportunity to participate in multiple companies. Yeah,
Hmm. So this is a wonder point, a full point you discussed about the difference between thematics and sectors. A lot of investors feel that thematics are as risky as sector funds,
correct,
and whereas it's a theme which has multiple sectors. So
correct.
it's not, and I truly agree to it. In fact, that definitely thematics are less riskier than sector funds. Uh, I think it was a wonderful discussion. I'm sure our investors have a lot of takeaways. They've got a lot of clarity on what is happening in the infra space, and how they can invest, and gain from this huge expenditure which the government is doing on the infra space overall. Just to sum it up, one what we can see clearly is that there is an increased focus of private sector spending on the capex, government focus on manufacturing, a stable government, which is going to be a key driver to if you want to see the next 5 years of stability in this sector. And definitely the most important thing is that we are highly deleveraged, and the banks have a very clean balance sheet, which will help in the future growth of this space. In fact, thank you very much, Charanjit, and I'll just pass it on to Unnati in case if she's got some questions from the audience. Thank you.
Sure. Thanks, Harish. Yeah,
That was an extremely informative session, sir. I think
thank
your
you.
views on having a holistic approach while investing in the infrastructure companies, understanding the risk reward for these companies and their valuation, while picking such themes has given us and investors a very good perspective. I'll just ask a few relevant questions from the audience. Moving to the first question, sir. What are the potential impacts of technological advancements like AI on infrastructure investments, and what impact do you see on the labor force because of
Hmm.
the AI now taking a lead in this segment?
Yeah, I think, Uniti, this is a very important point which I am trying to look at and trying to, see what are the impacts which are coming on the portfolios. Now, if you look at the global markets, so US and all these, markets are seeing huge demand for power. And you'll say why you are linking this with AI? Because when we talk about digitalization, This is a loop. Digitalization drives demands for data centers. Data centers drive demand for power, because data centers are power guzzlers. Their whole input requirement is power. At around 70%, input is power. So they are power guzzlers. And as we see artificial intelligence, AI, getting accelerated, US is talking about a decade long growth in the power demand curve. Fine. That's the one aspect, because you need that amount of power, because some of the chips which Nvidia and all these AI oriented companies are making, they are power guzzlers. They can take the power which one city requires. So it means that we are not ready still with our power infrastructure to fuel this entire AI push. That's the part of the infrastructure requirement. Second part is in terms of what is the implication, like you rightly asked, on the job market. Today, 54% of our GDP is coming from services. Large part is coming from IT exports. That is where the risk is increasingly coming in, that more and more AI could disrupt the job market. How do you then try to compensate for that? By building more manufacturing capacities, which can actually use the skilled manpower, and also bring in more capability into the Indian market, be it on the mobile phones, be it on the defense equipment, automobiles, the pharma oriented or chemical oriented. These manufacturing chains are, that is why, becoming essential, because we want to take this manufacturing from 18% to 25% as a percentage of GDP. And this is all being driven because of this fact that there's a big disruption because which is coming because of artificial intelligence. So I think these two aspects are very important when we look at also our portfolios, that how government policies are going to answer our huge power requirement which AI will fuel, the huge disruption which will come on the job market, and how they can bring in the new drivers for jobs like in the manufacturing sector.
Right, sir. That's very rightly said. Moving to my next question, sir. Infrastructure investments are often viewed as inflation sensitive, and now, as you mentioned, with the hybrid annuity model, where we are having government spending and also the private companies are spending, and also banks are having cleaner balance sheet. How do the changes in interest rates and inflation affect investments in infrastructure companies?
Yeah. So see, right now what we saw is that because of inflation, a lot of corporates actually had slowed down their capital expenditure, and everybody is waiting for some of these commodity prices corrections to come in. Also on the rate cycle, there could be an expectation that rates could start coming down in the future. So that could be another additional driver for some of the corporates to start going ahead and spending and doing the capex. So I think definitely there is an impact in the near term when you are putting in a new project. But when we look at the government capex is continuing because of the ability of the government to still raise money at a lower rate versus the corporates. Additionally, what we are also seeing is that government is looking at more from a developmental project, budget perspective. If you look at railways, the budget which used to be separate is now merged with the main budget, because they are looking railways as an activity which is similar to what we do in investment in healthcare or in education, because we need to build this infrastructure. Like Nilesh also talked about the urban infrastructure, be it metros, be it water projects. These are not options, but we need to spend because our population growth is happening. That is where government is trying to find out long term financing measures, where we have a long term financing coming from the Japanese banks or the pension funds, so that it can take care of the near term issues in terms of financing what we might have. Additionally, what we are seeing is that if we look at from the government perspective, they are seeing that definitely the population growth is going on. Urbanization, these are big trends. Water scarcity is becoming a big issue. So these are the areas which will not stop just because the inflation is high. Government has to spend. And if you look at last year, we had spent 3.3% as a percentage of GDP by the central government on capex. For the last 2 to 3 years, we have been doing more than 2% as a percentage of GDP on the central government capex. So this itself shows that government has continued to push in terms of doing infrastructure spending despite high interest rates, despite inflationary environment, because this will only give the confidence to the private sector to come back into the market and then start spending, because the central government has to start creating the demand. So while central government capex could see a kind of moderate growth rate, but that is seeing on a very high base. It may grow by around 8 to 10%, but that is essential now going forward to get the private capex also back.
So wonderful. I think that was a very
Hello.
informative session and intriguing session, sir. Thank you so much for making the time to grace this session. And on behalf of Cedrus Wealth Partners, I would like to thank DSP for arranging this event for us, and to all our viewers for tuning in and viewing the knowledge series. Thank you once again, and good evening to all. Thank you so much, sir.
Thank you.
Yeah.
Thank you, Charanjit, and wish everyone a good weekend, a long weekend. Thank you.
Thanks, Nilesh. Thanks, Unity. Thanks, everyone. Bye bye.
Bye.